more boring. It might have a lower representation of options in the store, but takes a huge chunk of the cash. And this is the bit of the business that allows you to trade in the high fashion stakes. We expect here to have all of our products in stock, in store, at any one time. Now, we're not aiming for 100% of that, and I'll talk about why in a little while, but we are expecting most customers to be able to come into the store to buy a pair of jeans and find their size, their leg length, the colour they want. It's a high level of stock investment. You have to carry a much higher level of inventory in the store to deliver that, but you've got a much longer life cycle. So you can afford to overstock effectively, so you miss no sales at all, and clear it with a very low markdown because you've run it for such a long period. Ideally, what we try and do is overstock at the start of the life cycle. So we will maybe allocate stock out in ratio packs to save money. We will maybe overstock stores slightly. As we go through the life cycle, we'll maybe then start to replenish in eaches, in singles, which rebalances any error in the allocation. And then at the end of the life cycle, we'll sort of just do eaches and then look for the markdown. And we tend to aim for less than 10% markdown spend to sales. Quite often we can close on 3 or 4% markdown spend to sales. The other thing that's key in here is constant analysis of your size ratios and how you package goods. Okay, this leads on to replenishment. Basically, when you allocate stock into store, I make a very clear distinction between allocation and replenishment. Allocation for us is the first placement of stock into a store. So it's the first time that store has ever seen that line. It goes in. That's the guess. That's when we are guessing what we're going to sell. And we will get that bit wrong. We will inevitably get that bit wrong. And the more allocation we do, the more we guess and the more markdown risk we have. But you have to put an amount of stock into a store to tell customers you have that in your store, that it's on sale, that you have volume of it. And quite often you've got to have enough in for at least 4 or 5 days' worth of sales before you can effectively start to replenish. But then replenishment kicks in. And traditional replenishment systems tend to either be one-for-one, so marry what you allocated out and then build back to that level, or rely on some fairly detailed forecasting, line-level forecasting. Now, we have 18 people now allocating and replenishing stock for 650 UK stores. We have roughly 5,000 new products coming in every probably 10 weeks. So you can't do individual line-level forecasts. It's not possible. So we stuck very much with a simple one-for-one method. And the one thing that we changed quite recently was looking for replenishment systems that were intelligent and smart that needed very little input. Because we have this flow of newness, what I really don't want people to be doing is spending hours and hours trying to forecast how things are selling. What I really want people to be doing is looking at the exceptions and spending most of their time looking at the forward ranges. So we implemented a system called Quantum Retail. And basically the clever bit, it was looking at, you allocate your line out to store, which is the bit we did. Once it started selling, it started to look at how well things were selling in those stores and by size. So if you had stores that had we have a lot of towns that have high Asian population. We tend to sell smaller sizes. By virtue of the way the demand happened and the sales happened, it rebuilt smaller sizes in those stores. We didn't do anything. It just happened. And the key really was it's a highly efficient way of managing scarce stock because the continuity product, frankly, if we overstock, doesn't really matter. On high fashion, when you've got limited amount left in your distribution centre, you want to place every single unit in the store most likely to sell that stock. This is a good example of what my merchants used to look at. We used to quite frequently look at cover at New Look. Now, I'm sure you all have different dynamics you look at in your business, but most of our business was looked at in terms of cover. The beauty of cover, and this is your closing stock units divided by the amount you sold that week. The beauty is it kind of indicates demand. So we'd look at lines that we allocated out to store. Those that were on sort of 2 weeks cover, we'd buy more of. Those were on 5 or 6 weeks cover, we wouldn't buy more of. Those were on 10, 12 weeks cover, we'd try and mark down. What this misses entirely, and unfortunately what most analysis misses entirely, is that Glasgow could have sold 25 units, sold out completely, the week before, didn't get any stock back in until the Saturday, sold 1 unit at 5 o'clock on the Saturday, therefore it looks like they're not selling it. But in fact they missed sales right the way through the week because they're out of stock. But we didn't look at that. And because we've got 5,000 products, 640 stores in the UK, another 300 in France, it runs into millions and millions of SKU store combinations, and you cannot look at that, which is why the systemic solutions help. And we have hundreds of examples of this where you look at the information and make a decision that's fundamentally wrong. So what we grid out is kind of 2 different ways of looking at our products. the high fashion and the fashion continuity. And we have different aims for each product. One, we're trying to keep in stock, basically, at all costs. We're expecting to have lots of inventory. We work really hard with our suppliers to have continuous production runs. We work really hard with our logistics companies to get it in the cheapest possible way. But it costs, because we have to pay up front for a lot of it. We have high levels of commitments on that stock. We have high levels in the store of that stock. And then we have the other bit that is almost the opposite. We don't actually want to never miss a sale. What we want to do is sell out of it as quick as we can, make the most profit we can, and get on to the next thing. And this is kind of how we distinguish between the two. I talked earlier about this thing, service level, and this was an important concept for us. We used to very much talk about availability, and I think a lot of people talk about availability, and I term that as having a unit of stock in a size in a store. So if I have 100% availability, it means I've got one of every size in every store in the chain. Now, obviously, that doesn't necessarily service all demand, because if I have one size 10 and somebody buys it in the morning, I don't have it, so I've missed a sale. The problem with that is there's sort of a Pareto curve to hitting 100% availability. And it's very easy to overstock your stores trying to chase after this elusive goal of 100% availability, and that can be extremely costly. And there's quite a few retailers who've overinvested in this and left themselves very exposed on cash flow and markdowns, because they've effectively looked at trying to not miss a sale, and that's fundamentally wrong. We kind of, on this scale, would traditionally be aiming for somewhere between 80 and 95% availability, not 100%. So we look at this thing called service level. Basically, what we're looking at service level is trying to calculate through customer demand for a product and trying to meet that level of customer demand. And that's the key bit. You're trying to meet your service. And what we did with Quantum is try to, they've got basically their replenishment works by looking at a demand forecast. And we tried to incorporate that to look at, well, let's target a service level. And what we found is we tend to aim between 80 and 95% of service level. On our real basic continuity products, we may be aiming for 97, 98% service level, but we're not aiming for 100%. For me, it's very important to distinguish the difference between allocation of stock to store and replenishment of stock in store. And for all lines, you have to do both. But the allocation bit is primarily a guess. For us, we allocate more than 50% of our products. On the basic continuity stock, it's maybe 20, 30%. On the high fashion stuff, it's maybe 60, 70%. But that's a huge chunk of stock you're putting into store and guessing how it's going to sell. We do constant analysis of that, what sizes are selling where, how we should configure our stock in packs, how we should get it into the stores. But it is always a guess. Replenishment is where you rebalance out those mistakes you're making, which is why for us replenishment was sort of the first thing we went into. That was where we're looking at now. I talked about 18 allocators for the entire business. What we're looking at now is how do we improve that allocation? And for me, this is about incorporating your allocation of stock to store within your range. So as the buyers and merchandisers are putting together range plans, assortment plans, but as they're starting to fill that in and starting to think about what products they're buying, they're actually forming the initial stages of the allocation. And we're putting quite a lot of work now into making sure that once they've bought their ranges, once they've filled in all the attributes they want, they've got the trends they need, happening on a sort of continuous basis, that actually forms the initial allocation. So that then just feeds in and the stock goes straight out to stores. So we're looking at as many efficiency wins as we can, because if we can keep ourselves as lean as humanly possible and as efficient as humanly possible, it leaves you in a very good place to ride the bumpiness, ride the downturn. And kind of what's all of that done? Well, the replenishment piece from Quantum we measured quite carefully and delivered us around about 1.5% like-for-like increase in sales. And we had quite a tough year, as most people did, but we've done pretty well, increased our margins substantially, and off the back of a huge space growth. This wasn't about becoming a smaller retailer, cutting down on our store sizes like a lot of retailers have done, closing shops. This was about aggressive space growth with efficiency growth at the same time. So we grew our overall sales by almost 15% and increased our market share from about 4.8 to just over 5%. So in summary, we feel that fast fashion is the key. People are becoming far more savvy to newness. People are not prepared to be fobbed off with the same old thing. And I think if you can do that very efficiently and very quickly, you're in a very good place to ride the difficult market.
Thank you, Spencer, for sharing insights into New Look's success.